Hi, stock investors. JJ here. Welcome back. Well, right now I'm going to react to this clip with Liz Young from SoFi, who thinks it's time to trim some gains in large caps. Being from SoFi, I'm sure she doesn't include SoFi in that. Is it a large cap? Probably not. It's getting to that way, isn't it, really? It depends what you consider a large cap, but I actually think she's probably talking about the mega caps. Let's find out.
After this week, we're going to get 2 more CPI prints before that September meeting. So the August pause builds in an opportunity for them to stay flexible. I think what happened today was, we didn't see.
Okay, so she's the head of investment strategy. I like to see what these people's jobs are. As I've said in this last video I did today, and on the main channel, on the Art of Value channel, I talked about how the chief strategist, market strategist from JP Morgan was let go recently because he was golden for 10 years. He had these great run for 10 years, and then 18 months he made some bad calls and lost some clients and money, and it was let go. It's brutal for these people, and they basically predict. Their job is to predict what's going to happen, or how to position, instead of just like an investor like Warren Buffett, who just looks at fundamentals and isn't concerned with the day-to-day, week-to-week predictions of the market. But anyway, let's see what she's got to say about trimming the large caps.
See the futures market move too much on what it was expecting in July or September. But I think if we get a cooler print on CPI this week, and if we get a cooler print on PPI, September will get priced in as a lock.
Okay, so what does that mean for me preparing for that as an investor? What do I do?
Well, I still think there's a contradiction. It seems like the market continues to cheer cooler data as long as earnings are strong. And that's okay, but as soon as we start cheering cooler data that sometime will catch up with earnings, I think the market's going to have to digest at what point is cool too cool.
Well, that's what Goldman was talking about today, right? I don't know if you saw that blurb from them. The idea that bad news is eventually going to be bad news for the market. Well, at least it could be.
Well, and
see, the market's been kind of shrugging off any kind of bad news, or remember when interest rates shot up, that was a huge, the market got a shock there, and a lot of tech stocks went down to 70, 80, 90% in some cases, emerging tech anyway. And so the market seems to be shrugging off the fact that there hasn't been interest rates cuts, and inflation has been coming down. So it's so far been shrugging off that kind of information, that kind of data. It's got used to inflation being, well, it's coming down, but being a bit higher, and interest rates being higher. I mean, don't forget, interest rates were at emergency levels since the global financial crisis, really. It's so low, and then they went to zero, and so it was a shock that they went up, but they're not historically high. At the moment, the interest rates are not historically high.
And there's been sort of this detachment. We want the economic data to get cooler, but earnings data needs to stay strong.
There you go. We're showing it on the screen right now.
And it continues to be that way. And I think this quarter probably continues to be that way as well, where we get cooler data in the economy. It confirms that the Fed can start cutting rates in September, and stocks will cheer that. But some of the things that I look at that are a little bit concerning about it is that even if we compare it to the mid-90s and say, okay, the Fed started cutting rates, everything was fine, we secured a soft landing. They started cutting rates at a point when the unemployment rate was 5.6% and falling. So they cut rates at that point into a strengthening labor market. At this point, we just crossed above 4% in unemployment. We've gone up for the last 3 months in a row. It will
I showed that in just the last clip. If you want to go back and see that there was a table of unemployment. It's just ticked up. It's been relatively flat, so I think the Fed will be watching that. They would be expecting it to come down because they've been raising rates, and there's a lag on that, and so it's not unexpected, and it's just starting to do that finally. Not great for people losing jobs, but the Fed will probably be okay with seeing that.
Likely continue to weaken. None of these numbers are concerning, but it will likely continue to weaken, and then the Fed will be cutting into a weakening labor market.
Sure,
which the market has to understand.
Yes, okay, but weakening from a high level.
From a tight spot.
So that's what the Fed chair said today, right? Yes, the labor market's cooled, but it's still strong, right? He used the word strong. It's back in balance.
Historically,
is
really
the labor
strong.
market. It's not like it's falling apart.
Correct.
It's just slowing.
No. Yeah.
Right. And his
which
idea
is kind of
not falling off a cliff, as we saw during, when the pandemic hit. employment just shot up. Well, the economy just stopped. That was historically incredible to see, and I don't think we'll ever see it. Well, can never say never, but we all saw that happening. It was incredible when people were getting laid off, furloughed.
Of what they need.
Yes, right now.
In some respects.
In this present moment right now, that is exactly what they need. And being back in balance is referencing more how many jobs are open versus how many people are unemployed in order to fill those jobs. We were way too tight before, driving wage costs up, and we all know that that put pressure on earnings in companies. The issue is that if you look over history, the longest history you can find of an unemployment rate, as it starts to rise, it hits escape velocity quickly, and it's difficult to stop that rise. The rises usually happen very fast. So right now...
So when a recession comes along, unemployment does tick up pretty fast, is what she's saying there.
We're still in a good sweet spot. Between 4 and 4.5%, I would call the sweet spot of the unemployment rate, because 4.5% is still what's considered frictional unemployment, what we can expect even in a healthy economy. So that's okay. What we need to not happen is that the speed picks up. If the speed picks up and we can't get a hold of it while the Fed is cutting rates, then it'll look like they're reacting to something that's getting weaker.
Okay, so maybe...
So, I mean, that's the similar with inflation, where they waited and it took off, went up to, 10%, and they were saying it's transitory, and they looked like they didn't know what they were doing. They looked like they were chasing inflation, and in fact they were, and it's taken a long time to get down. That really was a shock.
Maybe the most debatable idea you have that we can kick back and forth is this idea of a portfolio move to make right now. Trim some gains, particularly in large caps that are driving the market. You're talking about mega caps, okay? And allocate to sectors that benefit from steepening yield curve. We can go through what those are, but
sure.
You really want to take some profits off the table. I know you're smiling because
she's smiling about that because a lot of people won't be liking that, the sound of that. It has to be said, as I said in that last clip as well, that Warren Buffett took some Apple off the table, which was reasonably unexpected. He's known just to hold and hold even through when things get into kind of bubble scenarios, as he did with Coca-Cola, and he took some off the table. And Bill Ackman has just in Q1 took some Chipotle money off the table. When it ran up there, it's run up. It's started to come down again now. So I'm not saying he's timing, but they had a very good run there. From he explained. In a video I did on the Art of Value, he was there was a longer video there talking about Chipotle, and they got it when there was a food scare, when it was at a coli food scare, and it was so they've had an incredible run. He's made a lot of money from Chipotle, and obviously it's run up. There are other companies like Costco, some pretty high multiples out there for these large stocks, but we're talking about mega caps here, obviously Nvidia and those kinds of stocks.
Call, right?
Yeah.
I mean, some people are going to say, no way.
Yeah.
Why do you want to do it?
So whenever the market gets to extremes, it's at a higher risk of what I'll call normalization. I'm not even going to say mean reversion. I'll say normalization. Some of the metrics that are getting uncomfortably extreme right now are things like the forward PE ratio on the S&P is in the 89th percentile. The spread between the market cap weighted S&P and the equal weighted S&P over 1 year is 17%. That's in the 99th percentile. And then we've got the max drawdown this year so far, only 5%. If we hold that, that's in the 91st percentile. So we are...
Yeah, so I see what she's saying there. I just said in this last video, did I say it earlier in this video? I can't remember now. But the Schiller PE ratio, so cyclically adjusted here, it's crept up to 36 without many people realizing, just in that late 2021 where we had that bear market. After that, the 2022 bear market, it got up to 38, which is pretty high. It went up there. There was a lot of craziness going on then, though, with hundreds of SPACs coming out, the meme stocks, all that stuff. There's a lot of craziness going on, and the dot-com bubble got up to 44. So, some people are saying, some analysts like Dan Ives, Tom Lee, saying that we're in the early days of this AI-related boom. So who knows what's going to happen? You can't predict. Though it's people like Liz whose kind of job is to predict here. That was the last video I did, by the way, if you want to look at that. Anastasia Amoroso was saying much Much the same thing, really, that there may be a pullback, so they're kind of in agreement here.
Getting to the point of extremes, just in the sense of, okay, is it time for there to be what I would call a redistribution of strength? Okay, that doesn't mean that we have to have this big pullback, but when you get certain pockets of the market that are so overly valued compared to others, there might need to be a redistribution. Some people might call that a broadening.
Okay, well, that's what I'm going with, though, because
broadening.
Can you get
broadening of the market, meaning that the big stocks, the mega techs, will come down a little bit, but they'll be broadening out to other names.
Broadening. Do you think there's going to be and I'll use your words, a redistribution of strength at the same time where you appear to have some growing concerns about the strength of the economy? So, do I want to buy into your broadening story at the same time I buy into your weakening story? How do I do that?
So, good question. The broadening story that we've seen so many times has been a broadening into cyclicals, a broadening into small caps. What I would consider a broadening now is a broadening into those sectors that would do well, that tend to do well in a steepening yield curve environment, which is what I expect to happen in the second half if and when the Fed starts cutting rates. We'll see the 2-year come down. Some of it is financials as the yield curve steepens. Yes.
And keeping in mind that she's from SoFi, so that would benefit SoFi.
Financials should benefit from that. But the ones that tend to do well in a prolonged steepening environment are things like energy, stocks that are paying a good dividend, and then staples, utilities, healthcare. I'll put a little asterisk by healthcare because of the election. But those are the sectors that tend to do well. And that's not even a defensive statement. That's more of a dividend statement, and the ones that are not the high flyers that have benefited from.
Okay, I think we've got the gist there. She thinks there's going to be possibly a pullback and time to trim the mega caps. What do you think about that? Let me know in the comments. And I'm on the screen right now. I'm going to put a video that YouTube thinks that you should watch next, and a subscription link if you want to subscribe to this relatively new channel where I'm doing daily videos. Subscribe, and thanks for watching. I'll see you in the next one.